When I was 18, I saw an ad that said something like, "Make $500 a week selling a revolutionary product." The product was some kind of nutritional supplement. I don't remember exactly what it was. I think it was some kind of package of pills and powders and elixirs and so on. It was one of these life-transforming nutritional supplement packages. The ad said to go to a certain place at a certain time for a meeting about this revolutionary product. Out of curiosity, I went to the meeting. It was at night in a church basement, I think, in a big room, and lots of people were there. First, there was a speech promoting the product and the potential for selling it. Then various people who were sitting in the crowd but were already selling the product stood up and gave testimonials about how the product had changed their lives, how they were healthier and making lots of money. In many cases, the stories were extremely hard to believe. Now, of course, this was a multi-level marketing scheme. To join it, you had to buy a batch of the product. So you had to put money in up front to become a salesman. And you had to buy the product from somebody who was already in the scheme. They would get a percentage of that sale. Then you were expected to use the product yourself and also try to sell it to others, and also try to recruit new people into the scheme. And of course, if you recruited in new people, then you would get a percentage of the product that was sold to them. Although at the time I was rather naive about many things, I was not stupid. I understood that it was a scam, but I stayed until the end of the meeting because I thought it was interesting. Not the product, but the scam itself. I was amazed how many people signed up for the scheme. The nutritional supplements were probably of little value and were probably pretty hard to sell by themselves. It was the idea of the scheme that people were selling and buying. Multi-level marketing is a kind of pyramid scheme. What I mean by pyramid scheme is any investment scheme in which returns on investment are generated from new investments, not from some productive enterprise. So it's not like you're investing in something that is productive, that has some natural ability to generate a return, or even to pay back your original investment. You are investing in something in which any return you get depends on more people joining the scheme. So I'm going to use the term pyramid scheme in that broad sense, not in the narrow sense that you'll find in Wikipedia, but in this broad sense of any investment scheme where investors are paid using the money from new investors. And this includes schemes that aren't deliberate frauds, but are just self-organizing. So you don't even need somebody to come up with a pyramid scheme to plan it and set it up. Pyramid schemes can emerge by social dynamics in certain markets. Why do people fall for these schemes? Well, the uncharitable answer is that people are stupid. The more charitable answer is that people are not very good at understanding complex systems, especially ones involving feedback. So, for example, they don't understand exponential growth. Even simple exponential growth confuses most people. They find it almost impossible to imagine. People join these schemes because they see a pattern. They see that others have made money by joining the scheme, and so they infer that they will also make money by joining the scheme. And so they join. It's really not very complicated. It's a very simple thought process. Of course, these schemes often have a very complex system of ideas that is used mainly to obscure the simple underlying dynamics, which are bring in new investment to pay off existing investors and create the illusion of returns. But every pyramid scheme has its own myths, its own stories, its own narratives that help to justify it and obscure it. The pyramid scheme is almost a religion. It's a kind of crowd behavior. People are pulled into it because people imitate each other. And that's another reason why people fall for these schemes. People don't think for themselves. They imitate, they conform, they follow. Pyramid schemes are like ideologies. They give people a sense of belonging and the illusion of intellectual superiority. The ordinary person desperately wants to be somebody, and the pyramid scheme sells him that delusion for a while. And so, like any good fraud, everybody is complicit. The people who join the scheme are complicit in it because they want others to join, and because they are joining it for greedy reasons. They want to get something for nothing. The scheme promises something for nothing. People are greedy. They want to get something for nothing. They join, and then they try to get others to join as well. So it makes everybody complicit in the scheme. The economic and financial history of the last 20 years has been dominated by pyramid schemes and their collapses. I'm going to go through some of the bigger, more famous ones. For the most part, these are self-organizing. They were not deliberate attempts at fraud or manipulation, although fraud and manipulation played a role in them. Unscrupulous people took advantage of these schemes to make money, or at least to try to make money. But the schemes themselves did not depend on fraud and manipulation as their primary driving force. The primary driving force was the greed and stupidity of the ordinary person. I'll start with the internet stock bubble of the late 1990s. Stocks had been growing in popularity for savings and investment since the early 1980s. There had already been some big successes for computer companies, such as Microsoft and Apple. In the 1990s, it became apparent that the internet was going to have a revolutionary impact on our lives. People started buying stocks related to the internet, computers, and communications technology. Now, before I go on, I should explain what a stock is. A stock is a share in a company. Stocks return money to shareholders by paying dividends. Dividends are kind of like interest. If you own a share in a company, then the managers of the company or the board of the company can decide to pay dividends to shareholders. And dividends are a share in the profit of the company. But many stocks don't pay dividends. And many people buy stocks not for dividends, but because they expect the stocks to increase in price. During the 1990s, stock market investing became popular among ordinary people to a degree that hadn't been seen since the 1920s. People became obsessed with changes in stock market indices, such as the Dow Jones Industrial Average, or the S&P 500, or the Nasdaq Index. This gave them a pretense of knowledge. They were looking at these single variable models of the market, seeing them go up and down, but mostly up over longer periods of time. And this gave them a feeling that they understood what is going on in the market. That feeling was based on very little information. A stock market index is almost completely useless as a guide to investing. It really is. But a lot of people came to believe that they understood the stock market because they recognized these words, the Dow Jones Industrial Average or the S&P 500, and they could tell you roughly what the numbers were, and the numbers were going up or something. And those who bought stocks watched their portfolio values on paper rise over time. So, of course, this led to ever-increasing confidence. It led to hubris. And what is more, people came to view markets, especially the stock market, as a kind of magic wealth generator. They came to believe that stocks should provide returns by going up in price, that this was their normal and proper behavior. So they came to view the stock market as something that was supposed to go up in price over time and magically generate wealth, without them having to do any real thinking about it, without them having to use intelligence in picking one investment versus another, without them having to put any effort into getting that return, and without them having to take any real risk. So they came to believe in this idea that putting money into these assets was a magic way to get wealth. And I say magic because the only way to create wealth is to work. You need resources, natural resources, and you need labor. And those things together can produce wealth. Just buying and selling things by itself cannot produce wealth. But people came to believe in this myth that stocks were a magic source of wealth and that the stock market should always go up. This view was promoted by not only the media, but also by the Federal Reserve. They helped to create that impression of the stock market as a free money generator. Whenever the stock market dipped or crashed, the Fed would lower interest rates, and that usually had the effect of reversing declines in the stock market. So people also came to believe in this myth that the Federal Reserve could manage markets, and that this was part of its job, that this was part of the mandate of the Federal Reserve. And the chairman of the Fed at the time was Alan Greenspan, and they called him the maestro, as if, he had some sort of magic wand that he kind of waved, a magic wand of interest rates, and this would make markets always go up. Now, that's not true. It's not true that the Fed can do that reliably, and it's also not true that the Fed has a mandate to do that. The Fed's mandate has nothing to do with the stock market, but that became part of its implicit mandate because that myth just emerged in the public's shared consciousness. That became an accepted truth, that the government and the Fed were responsible for maintaining this magic money machine that would just give people money if they put money in. They could get more out later. Now, in a sense, the stock market itself is a pyramid scheme as I have defined it. At least if investors expect to get returns from price increases. If you expect to get a real return from an increasing price, and you think that that should occur generally, that that's the general pattern, then the stock market is a pyramid scheme, because what you're expecting is that the next person who buys the stocks that you have will pay more money for them. And so what you need is that every year the prices of stocks will go up and new investors will have to pay more for the same stocks. For every seller, there is a buyer, right? There has to be a buyer. The only way that a stock returns value to shareholders over its lifetime is through dividends. Now, it is true that sometimes companies buy back stock instead of issuing dividends, and that is another way that companies can return value. So the only returns that can come from a stock are those that come from the profits of the company, right, by either issuing dividends or buying back stock. So let's just forget about companies buying back stock because it confuses it a little bit. And let's just pretend that that's dividends. So if the price doubles, but the stock doesn't pay dividends, the company hasn't generated that return. New investors have generated that return. Okay, so it gets very complicated because, of course, the new investors might perceive that the company is now twice as valuable, and it is possible that what the company has done is increase its actual value, but that's not the only way in which a stock can double in price. And regardless of the value of the company, the money that you get when you sell a stock comes from investors. It doesn't come from the company. Unless, as I said, the company is buying back stock, which is a complication. But it doesn't really change the basic idea. So the stock market is a way to transfer wealth from one person to another, for the most part. And there's also a little transfer of wealth to companies at the very beginning when a stock is issued, and then back from companies to shareholders during the lifetime of the stock. During the internet bubble, people were buying stocks that had never issued a dividend, for companies that had never generated a profit, and might never generate a profit. They were buying stocks speculating that the stocks would increase in price and maybe someday pay dividends, but most people were buying the stocks for price increases. They expected them to go up in price. The expectation of price increases became a self-fulfilling expectation, because if people expected the price to go up, they bought the stocks, which thus increased the demand for the stocks, which increased the price. So you had price increases driving the expectation of future returns, driving demand for stocks, driving price increases in a cycle. But this can't go on forever. For a while, people saw others getting rich and they wanted to join in, so more and more people were entering the internet stock market, buying stocks and trading them at higher and higher prices. But eventually, the flow of new investment into internet stocks started to slow down. And then the demand started to fall. And so the imbalance between supply and demand that drove up the price was reversed. And so prices started to fall. The feedback loop operates in reverse. Falling prices, or even stagnant prices, lower the expectation of returns, which then, of course, makes people want to sell even more. And so when the feedback loop runs in reverse, the price falls very quickly. And that's called a crash, or the bubble bursting. When that happened, which it did sometime around March 2000, a lot of people lost a lot of money. Of course, a lot of people had gained money on the way up, right? So it was really a wealth transfer. Wealth is not created by price increases, and wealth is not lost by price decreases. The companies were the same before and after, right? Well, they may have done some things in the interim, but changing the price of the stock doesn't change the company. It doesn't make it better or worse than it was before. The big winners in this bubble were the people who sold internet stocks in the first place. Some were speculators who rode it most of the way to the top and then got out early. But I think the biggest winners were internet company executives and employees who got paid a lot of money from investors and never gave those investors a profit. A lot of these companies never returned a profit. They just operated at a loss until they had to shut down. And the people operating these losing companies often lived very lavish lifestyles, despite the fact that they weren't generating any net wealth, right? They weren't being productive. Their labor was not producing anything of value. So it's important to understand this. When you divert activity away from productive enterprises to unproductive enterprises, that is a loss of real economic productivity, right? The real production of goods and services that people want is lowered by diverting labor and resources to unproductive enterprises. And that's one of the problems with these bubbles, is that they divert labor and resources to things that turn out not to be very useful. or not as useful as people thought they were going to be. So you end up wasting a lot of labor and resources. So you get lower real economic growth during the bubble, or even negative growth, but that is masked by asset price inflation. It seems like the economy is booming when actually it is just consuming itself. It is just destroying wealth. The internet stock crash was followed by a recession, mainly because labor and resources had been diverted into unproductive enterprises. So real economic growth was lower than people thought it was. So a lot of the recession is not it's not really a negative thing. The bad stuff happens during the bubble. The recession that follows is just the revaluation of the economy and also the reallocation of labor and resources. You have to lay people off to shuffle them to more productive enterprises. So think about that. A recession is not an actual decline in real economic output. It is more the recognition that economic output is lower than it appeared to be. Okay, I know that's a little bit confusing. But think about it. We're building things we don't really need, right? We're building software that's pretty fucking useless, and all of a sudden we just realize, oh, the software is useless. So what counted as economic output before now has a value of 0. So it no longer counts as output. So you can think about the GDP falling for that reason alone, because what appeared to be output before is now devalued. Anyway, after the internet stock market crash, the Federal Reserve lowered rates, and then we had the 9/11 attacks, which led to another recession, or longer, kind of deeper recession. And during that, the Federal Reserve lowered rates quite a bit, and so there were very low rates during that period. Not as low as they are today, though, I don't think. So that helped to pave the way for the next big pyramid scheme, the Great Housing Bubble. I call the housing bubble a pyramid scheme for the same reason that the internet stock bubble was a pyramid scheme. Returns came from new investors. They didn't come from the productivity of the assets. They came from new investors entering the market. And of course, it operated in the same basic way. As prices went up, that created the expectation of future increases, which created increased demand, which created increased prices, and thus expectations, and thus demand, etc., until it reached a peak at which prices were just too high for most people to consider buying houses. And one thing that the media almost never talked about during this time was how many young people got royally screwed by this bubble. And I'm talking not about people who bought houses, but about people who couldn't buy houses, who were forced to move away from their hometowns, who were forced to give up their dreams of home ownership, maybe of having a family, because they could not afford a house. The great American dream was supposed to be owning your own home and having that little white picket fence, little yard, little house. And that was pushed out of reach by the housing bubble. Even though, ironically, part of what created the housing bubble was the attempt to expand home ownership. So the government did play a role in this. They had these agencies, Freddie Mac and Fannie Mae, that bought mortgages from banks. I won't try to explain the whole financial underpinnings of the mortgage market. It's a little bit complicated. But basically, banks supply mortgages to individuals. Individuals borrow money from banks. Banks can keep those mortgages on their books, or they can sell mortgages to other investors. Freddie Mac and Fannie Mae would buy mortgages from banks, and they would then sell bonds to buy those mortgages and then You could invest in the housing market essentially by buying Freddie Mac or Fannie Mae bonds. But you could also buy bonds directly from banks, or, in a sense, if you put money in the bank and left it there, well, then, you're an investor in all of the mortgages that the bank has. So I should point out that this weird feedback between price increases and increasing demand only works for assets that people intend to sell, right? It only makes sense when you are trying to make money from an increase in an asset price. Markets for commodities or consumables work in the opposite way. Like wheat, for example. If the price of wheat goes up, the demand for wheat goes down. It doesn't go up. But with assets that people are using to speculate or invest, increasing prices can increase demand for some period of time until the price gets too high or the demand dries up, right? So that's the difference between these two types of dynamics. The balance between supply and demand works very well for consumable goods, but it doesn't work as well for investment assets. The media played a fairly big role in the internet stock bubble. They hyped internet stocks, and they did the same thing for the housing bubble. I remember this time, and I was amazed that right after the internet bubble, people jumped into the housing bubble, and they didn't seem to realize that these two things had something in common. They didn't seem to recognize the pattern. I was quite shocked by that. And the media, instead of correcting people's delusions, they helped to amplify them. They helped to magnify their delusions. One way they did this was by perpetuating this fundamental fallacy about markets, that people make money in aggregate when prices go up, right? So that if lots of people own stocks and the price of stocks goes up, then we're all richer, which is not true. That's the fallacy of composition. It assumes that the price is independent of people trying to sell. And this means, by the way, that market capitalization is a meaningless number. So let's say the market capitalization of a company is $1 billion, okay? And each share is worth $100. What that billion number means is that if you add up all the shares at the current transaction price of $100, you get $1 billion. But what it doesn't mean is that the current shareholders could liquidate their shares and get $1 billion. And it doesn't mean that the company itself is actually worth $1 billion. It just means that if you take the price of the last transaction in the stock and you multiply it by the number of shares, you get $1 billion. Now let's say people started trying to liquidate this asset, the shares in this company. As they started selling, the price would start to fall because there would be more supply than demand. And of course, that's what happens with houses as well. It is sometimes said that, I can't remember what it was, maybe $1 trillion of so-called wealth was wiped out when the housing market crashed, but no real wealth was wiped out by the crash. The crash was just a revaluation of existing assets. If your house went down in price, that didn't mean that suddenly the roof started leaking and the foundation cracked and, all your lawn died. I don't know what, the wiring stopped working or the plumbing sprung leaks or whatever. It just meant that the market revalued that house. The house didn't change, and the house is the real wealth. But anyway, people get confused about these things. So the media played a big role in confusing people. The main way they did this is just in the way they attached value judgments to market prices. And they still do this today, and it really pisses me off. when they do the numbers, right, they give you the stock market numbers or the housing market numbers, up is good and down is bad. They'll say, great news, the stock market went up by 1% today, or it was a terrible day in the market. The S&P 500 lost 2% of its value today. Or it's been a great year for the housing market. Prices have gone up by 10%. In doing that, they are taking the seller's perspective. They are ignoring the buyer's perspective. And they are ignoring the fact that for every seller, there must be a buyer. Right? That's just so fucking obvious, but people can't seem to grasp this very simple principle that for every seller, there must be a buyer. So if prices go up, that's good for sellers, it's bad for buyers. Aggregated over the population, it does not provide any net benefit whatsoever. Okay, so that's important to understand. But the media reported this as if everybody was getting richer when the housing market and the stock market were going up. They ignored that many people were being shut out of the market. And the young people would find it very difficult to buy houses. They would have to work many more years of their lives simply to pay for the same thing that their parents had to work fewer years to own. The point is that the amount of labor required to own the same thing had gone up, and that is not good for the people who have to do the work. And I would argue it's not very good for society as a whole to create those kinds of generational imbalances. What the media did was they helped to create and perpetuate the myth that goes along with almost every pyramid scheme. They reinforced, rather than corrected, the natural stupidity and greed of the masses. They were feeding back popular misconceptions to people, reinforcing them, and promoting participation in this pyramid scheme. So again, everyone is complicit in these things. Government, media, and ordinary people are all colluding to deceive themselves. So people came to believe the myth that houses were magical wealth generators, just as they had believed the myth that internet stocks, or stocks in general, were magical wealth generators. The housing bubble was much bigger than the internet stock market bubble, and it had more serious consequences. People usually borrow to buy houses. During the bubble, banks and other institutions had issued a lot of mortgages, often with very low down payments, based on the false expectation that prices would always go up. When prices started to fall, those mortgages were in a high risk of default. Many people could not pay for the houses that they had bought with borrowed money. Some were abandoning houses that they bought. This left banks and other financial institutions basically insolvent because they were left holding the bag. They were the ones left holding the hot potato. Well, as you'll see, they weren't the last ones. They passed it to the government, but they owned these mortgages that were not going to be paid off. So again, it was a revaluation of the real economy. One of the things I remember from this was how the media struggled to come up with a narrative after the crash. I remember this specifically about NPR. At the time, I used to drive to work, and I would often listen to NPR on the radio as I drove. And I found myself infuriated to the point where I had to stop listening to it because of the way they were desperately trying to come up with a false narrative that would exonerate them, exonerate the average person, and pin the blame on some kind of convenient scapegoat. What they finally came up with was that the financial crisis was due to complicated financial instruments. And, they would talk about these things as if, oh, that's so complicated, I can't understand that. Nobody could be expected to understand a collateralized debt obligation. It has too many words in it. They acted like these things were just so fucking complicated. And they talked about, bonds that had these different structures, as being really complicated, which I'm sure they were legally complicated. But, if you're an investor, why would you buy a bond that you don't understand? Unless you're greedy or you expect to be bailed out or you're stupid. So either way, you're greedy or stupid, or probably both. But the media did not want to blame individual investors. They wanted to blame anonymous investment bankers, right? These anonymous people who supposedly were running all these fraudulent schemes and so on. And there's some truth to that. It's not like there were no investment bankers engaged in fraud, but there were plenty of individual investors who were also committing fraud, who were lying on their mortgage applications. It was a big self-organizing delusion. And the media had played a big role in creating that. The media also would say that nobody could have seen this coming, or who could have predicted this? When, just a few months prior, they were chuckling at so-called contrarians who were predicting it. And not only that, it's not hard to predict. It's incredibly obvious, actually. You just have to think about the basic fundamental principle that every seller needs a buyer, and that savings have to be invested in some productive enterprise to generate a return. Individuals can get rich by buying and selling, but we can't all get rich by buying and selling. In aggregate, that generates zero wealth. And that's all you have to understand to realize that these bubbles are not generating wealth and they are going to burst. It's really not that hard to predict. Well, of course, after this happened, governments and central banks stepped in to bail out the commercial banks and various other financial institutions, including some investment banks, insurance companies, Fannie and Freddie. I can't even remember all the things they bailed out, plus some companies that were going under. It was just a big mess. And the government bailed everybody out, pretty much. Of course, governments don't magically generate wealth either. So when people get bailed out, that wealth has to come from somewhere. All right? It's still just a transfer of wealth from responsible and productive people to irresponsible and unproductive people. That's what they did. That's what governments do when they bail out individuals or corporations. They are transferring from responsible and productive people and institutions to irresponsible and unproductive people and institutions. So how do they do this? Well, they borrow or print money, and they use it to buy the troubled assets or to shore up markets, or often they just buy government bonds. A lot of what the Fed does is just buy government bonds, usually treasuries, to manipulate interest rates. Anyway, so where does the money come from? Where does the money come from in these bailouts? Well, it comes from savers. And it doesn't matter whether the government prints or borrows money. It still comes from savers. If the government borrows money on the bond markets, then savers are buying its bonds. Savers are giving the government money to use now with the expectation of getting a return from the government later. Right? So that's what happens if you buy a government bond. You expect to get your money back plus some change in the future. If the government prints money, or if the central bank prints money and uses it to buy government bonds, which is how that usually works, then the government is confiscating wealth from savers because it is inflating the money supply. It is increasing the amount of money, and thus it is decreasing the value of money. Now, that doesn't necessarily mean that you will get price inflation. What you might do is prevent price deflation. but you're still robbing money from savers. So if somebody was saving money with, the hope that later they would be able to spend it, they will now get less when they spend it because the government printed money and used it to buy stuff, which drove up the prices of things. Or they used it to bail out homeowners, meaning that the houses wouldn't fall in price as much as otherwise would be expected, and they wouldn't end up on the markets where responsible and productive people who had savings could buy them. So the government was robbing savers when it did that. And it was rewarding the unproductive and irresponsible. And in many cases, it was rewarding fraud. But at the very least, it was rewarding greed and stupidity. So that's the worst thing about bailouts, that they create perverse incentives. After the 2008 financial crisis, there was a long and deep recession, which really is a period of economic stagnation. Governments around the world not only bailed out the losers from the housing crash, they also tried to stimulate the economy with low interest rates and government spending, financed mostly by printing money. This is called Keynesian stimulus. Now, I think in some situations, Keynesian stimulus can bootstrap an economy to higher levels of aggregate production and consumption. Sometimes. But it has to be used rarely for it to be effective. It's kind of like a whip. It's kind of like you have a horse-drawn buggy, and if the horse dawdles or, stops for no reason, and you give it a flick of the whip to get it going again, the whip will be an effective tool. It will encourage the horse to go forward. But if you constantly whip the horse for no reason, or say because the horse is trying to go up a hill, or because the tires are stuck in the mud or something, if you're constantly whipping the horse is going to slow down. It might still go a little bit faster when you whip it harder, but it's going to get tired, it's going to get frustrated, and it's going to learn that going fast is pointless because it will still get whipped. Okay, the economy is something like that horse. And Keynesian stimulus is something like that whip. If you constantly apply Keynesian stimulus, if you constantly try to push the economy to higher levels of production and consumption, it's going to become dysfunctional and it's going to slow down. And we have seen that in recent times in Japan. Japan has had a very long period of economic stagnation. They had a very big bubble back, I think it was in the 80s, maybe into the early 90s, and then it crashed, and they never allowed it to fully crash. They just kept trying to stimulate their economy to no avail. And we have seen that since 2008. Governments in Europe and the United States, Canada, have all tried to stimulate their economies with spending and low interest rates, and those efforts have been a failure. We didn't have a Great Depression, we've just had a great stagnation, which might actually be worse. The problem is that if you keep interest rates low, you allow bad investments to just kind of cling on by their fingernails, right? You allow companies to roll over their debts even if they can never pay them off. You prevent the reallocation of assets and labor to more productive enterprises, and that perpetuates economic failure or underperformance. So in the long run, the Austrians are always right. Keynes said, in the long run, we are all dead, but in the long run, we are all Austrians. Because in the short run, yes, Keynesian stimulus can work occasionally, but in the long run, it doesn't. So by bailing out all of these losers, whether it's the banks or individuals who bought houses they couldn't afford, or financial institutions, or companies like GM, the government was just perpetuating failure. And the unpayable debts of those people and institutions were, to some extent, transferred onto the balance sheets of governments and central banks. And of course, central banks, even if they are quasi-private institutions, are still proxy agents for the government. You might even argue that the government is a proxy agent for the central bank in the United States, but, well, that's another topic. We went from the internet stock market bubble, which was a voluntary bubble with almost no bailout, just a tiny bailout by the Fed. Well, it turned into a fairly long bailout, but no government bailout, no direct payments to losers, to a much bigger bubble, which involved a huge government bailout and lots of payments to losers. And now we have a giant government debt bubble, which is just another pyramid scheme. And at some point, every pyramid scheme comes to an end. Governments can't finance themselves forever by borrowing or printing money. Borrowing eventually leads to bad credit and higher interest rates. Even for governments, you can't borrow forever, because eventually you'll run out of people who are willing to invest in the government. And at some point, interest payments are going to consume the entire budget. And nobody is going to want to invest in the government when that happens. Printing money has a similar problem. If you print money, that will eventually lead to price inflation, which is the devaluation of money. Both of these things are vicious cycles. If you have to pay off what you borrow by borrowing more every year, you keep digging yourself into a deeper hole, right? Because every year you have to borrow more money to pay off your existing debts with interest. If you print money, then because prices are going to go up, every year you will have to print more to provide the same services, right? To have the government operate at the same level and to pay your workers the same effective salaries in terms of purchasing power, you will have to print more money. So either way, it's a vicious cycle. And eventually it has to come to an end. It always does. It's very difficult to avoid participation in this scheme because governments can confiscate wealth by taxing or printing money, but when they do that, they discourage people from being productive and responsible. They discourage people from creating wealth or saving for the future. So, one way or the other, eventually, this pyramid scheme will collapse. And Greece is an example of that. The Greeks have no conceivable way of paying off their debts, but neither does the United States. The Greeks have no conceivable way of continuing their social welfare programs, especially their pensions and their, benefits to people in old age. But neither does the US. So we have this giant global pyramid scheme. Now, what people often say is that, well, there's one solution to this problem. There is a solution. And it's economic growth. If we can just make the economy grow faster, then even though our debts will grow as well, we can pay the debts of the past by taxing the future, and it won't be a huge burden because there will be more people and they will be richer. But this is just another pyramid scheme. It assumes that each new generation will be forced into this giant pyramid scheme to pay for the previous. And the idea that you can always expand the economy or the population is false. It's just as silly as the idea that house prices can go up forever or internet stocks can go up forever. Populations and economies can't grow forever. All of that economic and population growth was funded mostly by extracting oil and coal from the earth. And those are finite resources. So I don't think we will be able to grow our way out of the current government debt pyramid scheme. We're going to have to accept that wealth is created by work and natural resources. There is no magic wealth generation scheme. Every pyramid scheme is an illusion. It's not real. And we have wasted an awful lot of time chasing these illusions. rather than being productive and responsible.